Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics or Finance Excellency batch. Okay, so what we have been doing is we have been discussing about the Keynesian theory of national income, and in that we have already discussed about the two-sector model, right? What we have discussed about is we have discussed about the two-sector model. Now we are moving on to the three-sector model. As we say, the two-sector model is a hypothetical model where only the household sector and the business sector exist. In the three sector model, he says there is a government sector also. Without governments, can the economies run? No, sir. That is why we say that two sector is a hypothetical model, whereas three sector model is quite a realistic model, right? Now we have, in a three sector model, we have three participating sectors: household sector, business sector, and the government sector. Clear? So first thing what we are going to understand is the circular flow of income in a three sector model, that how this circular flow of income moves in the three sector model, right? More or less the things will remain same. Let's see. The first thing it says, the households provide the factor services to the firms, and in return the firms pay to the household in the form of factor payments. This we have already discussed in the two sector model, right? Where the transaction is taking place between the households and the firms, right? If you look at it here, now the firm and the households are there. These are the two sectors. And the third sector which is added, this is the first sector, this is the second sector, and this is the third sector that is added, that is the government sector. Now what they are saying is the households are providing the factor services. Households are providing the factor services, and in return they are getting the factor incomes, right? This becomes the personal income of the household. From the firm point of view, it is a factor payment, that is they are making payment to the factors of production, and to the factors of production it is their personal income, right? So that is why the personal income is written here. Clear, sir? Now, next he says, the firms provide goods and services to household, and the households pay for these goods and services, which is the income for the firms. This again we have discussed. This is a normal transaction that is taking place in a two-sector model, that the firms are providing the goods and services, right? The goods and services to whom? The households, and the households are doing the consumption expenditure, right? Are doing the consumption expenditure. This product market is the intermediate market where the firms are providing their product and the household are buying the product. That's it, right? That is an intermediary market. So the household is spending the money on the consumption expenditure on the domestic product, this one which the firms are manufacturing. The firms are providing the goods and services to household, and the households are doing the consumption expenditure by buying those domestic goods and services being produced. Now the next he says, households out of the factor income received pay taxes to the government, and in return the government pay to households in the form of transfer payments like the pensions, etc. Now comes the transaction between the third sector, that is the involvement of the government sector. He says the households pay taxes, right? The households are paying the taxes, obviously out of the personal income that these households are earning. Out of that they will be paying taxes to the government, because the government sector exists in the three sector model, right? And in return, what is the government doing? Out of the tax income, the government will be providing the transfer payments, that is the pension. Now during the earning years you are paying the taxes, right? Once you retire, the government pay you the pension. Now out of what? Out of the taxes that the government is collecting, they are paying you the pension, isn't it? So that is a transfer payment. So on one hand the government is taking the taxes from you, on the other hand they are providing the transfer payments to you. Clear? That is one transaction. Next he says, the firms, out of the income earned by selling the goods and services to households, pay taxes to the government, and in return receive subsidies and other services from the government. Now he says the same thing is there with the firms also. Now if the firms are going to sell the goods and services, right, to the household sector, that means they will be earning something. On that earning they will be paying these taxes, and in return the government will provide them with the subsidies or other any benefits to the firm, right? Out of what? The subsidies are paid out of what? The subsidies are provided out of the taxes only, isn't it? Okay, the next is the households deposit the excess saving in the financial market. Now there is one more player, that is the financial market here. He says the households provide the savings. For example, take a very simple example you must have been doing. That whatever the excess money is there in your account, you deposit in the bank and you can create an FD out of that, right? A fixed deposit out of that. You must have done it or your parents must have done it, right? You must have seen it at your home, that whatever the excess savings are deposited into the bank account, and then you create, if the excess savings are too much, you create the fixed deposit out of that. So that is the savings in the financial market. And these financial markets then provide the money to the firms in the form of investment, right? Or he says the firm raise money from the financial markets and invest in the product market. They raise money. Now, this is 9, that is the savings by household. Out of those savings, the financial markets provide money to the firms. That is 10th. Now, why firms need money? Because the firms need to what? Need to invest in the product. So they are investing that money in the product market. That is the investment expenditure by the firms. Clear? Next, the government borrow from the financial markets to compensate for any shortfalls in their budget. Now he says the governments can borrow the money, that is government borrowing from the financial market. Okay, so that becomes my 12th point. So the government borrows from the financial market if there is any shortfall as per their budget, right? You all of you must have seen the budgets, right? The budgets are created in anticipation of the future, right? That this is the government borrowing or this is the government expenditure that we are planning to do. And in case they fall short of the money while doing the expenditure, right? The expenditure is done for the welfare of the economy only. And in case the government falls short of the money in doing that, the government borrows from the financial market. That is a simple concept. Okay. And the government may also deposit their excess money as the savings in the financial market. So if the government has excess money, right, market here they can deposit excess money. Here they can deposit excess money. So the government can also deposit their excess money. That is the 13th point. In the financial market, the governments can deposit their excess money in the financial markets. Clear? So this is how the governments play the role. This is how the circular flow of income continues, that one particular sector is providing something to that, taking something from that. And basically, what is the role of government? Now we will be understanding, right? The government and household. Let's try to understand it in a little simpler way, I would say, right? So what we are going to understand is the three sector model. The three sector model, right? We'll just simplify the things a little bit for you quickly, will not take much of your time. That is, now the government is doing the transactions for both the sectors which existed earlier also in the two sector model, that is the households and the firms. Right now, what are the transactions taking place with the households? Let's see what are the transactions taking place with the household. The households pay taxes to government, right? And on the other hand, the government give transfer payments. The government give transfer payments to households. So these are the two transactions. Now, if you look at the firms out of the income, they will also pay taxes to government. And on the other hand, the firms will receive subsidies from government, right? On the other hand, they will be receiving the subsidies from the government. So basically, this is the role of government when it comes to the three sector model. So on one hand, the government will be taking the taxes, but on the other hand, the government will be giving also something. If they are collecting taxes, what is the role of taking the taxes? The motive or the purpose of collecting the taxes is to spend those taxes on the people itself, right? So in one form they will be collecting taxes, on the other hand they will be providing something out of the taxes to the households and to the firms also. This is what you need to understand, right? So this is the circular flow of income which we have discussed, right? So I've simplified it in a very simple way, and in the exam, sir, if the question comes to write the circular flow of income in a three sector model, can we write it what you have written? Yes, absolutely, 100% you can write it what is written in the books, right? It is not that we have simplified the language which cannot be used in the examination. Sir, we have used the language which can be used in the examination. What they are testing is they want to test your knowledge, that whether you have understood the concept, whether you have the knowledge for that or not. Understood? Right, sir. Okay, now the next part is the equilibrium determination in a three sector model. How the equilibrium determination takes place in a three sector model, right? Try to understand. We'll go very slow and we will try to, not slow, but we will try to understand here. What is that? That is the equilibrium. We'll understand in a simpler way. Equilibrium level of income in three sector model. In three sector model, just try to understand, just follow what I am saying, right? Then you will be able to understand there. Okay, we have studied about the aggregate demand. Yes, sir. What is that? The aggregate demand is the demand for the consumer goods plus the demand for the investment goods, right? That is consumption expenditure plus the investment expenditure. This is what we have studied in the two sector model. Now, in the three sector model, there will be another expenditure, that is the government expenditure. This is what? This is your government expenditure. Now, government expenditure on what, sir? Government expenditure on buying the goods and services. Government expenditure on buying goods and services. So there is additional demand that is being created. That is additional demand that is being created, because earlier there was a demand for the consumer goods, that is the households will demand the consumer goods, plus if there is any investment expenditure that is to be done by the firms, that was the aggregate demand. Now the government says, I also have a play, I will also buy goods and services from the firm. I can, right? The government can buy the goods and services and pay to the firms. That is an additional demand that is being created with the government expenditure. Okay, understood? So this is the additional demand that is being created. Now, on the other hand, we have studied about aggregate supply also. Now, what is aggregate supply? What is aggregate supply? Sir, this aggregate supply is dependent upon YD. YD is what? The disposable income. That whatever the income the households have in hand, that is the disposable income, according to that, the firms will provide the supply, right? According to that, the firms will manufacture the goods and supply the goods, so that there is an equilibrium level. Because what will be the demand? The demand will be equal to whatever your disposable income is, whatever the income you have in hand at disposal, that will be what the income is. Now, what will be the disposable income here? Sir, the disposable income will be the one which you have received for the consumption expenditure, plus you have saved some money. You have saved some money, right? This is the total income that you are receiving. That is, one, you are ready to spend on the consumption expenditure, plus another part is that you are saving the money. That is what we studied in the two sector model. Now, what will happen in the three sector model? The government says that you have consumption expenditure, you have savings, but at the same time, you will need to pay the taxes. You will need to pay the what? You will need to pay the taxes. So out of this, what is your disposable income? Consumption plus savings minus the taxes, right? So this is what, savings plus taxes. Okay, disposable income will be whatever you are paying in the form of taxes, right? Wait. What I am saying is, one second. What will be the disposable income? It will be plus taxes. How, sir? How, sir? Let's say, what is your disposable income? You earned 100 rupees, right? You earned 100 rupees. Out of that, you are spending on consumption, let's say 50 rupees. You are saving, right? You are saving 30 rupees and you have paid the taxes of 20 rupees, right? And why the taxes are being added here, try to understand. The taxes should have been deducted here to calculate the disposable income. You are absolutely correct. But at the same time, using these taxes, the government is providing the transfer payments. Using these taxes, the government is providing the transfer payments, right? The transfer payments, which again becomes your disposable income, which is a part of disposable income. That is why this has been added, whatever the savings plus the taxes, right? Even here, this is what is given to you in the module, right? So this is what we have here, the savings plus the taxes. Now, if you look at this, this is what? This aggregate demand is equal to your Y function. This is what is done here. Total income. The total income you can spend either on the consumer goods, or you can spend on the investment goods, or it will be the government expenditure, isn't it? So we say, and we have studied about an equation here, y is equal to yd. That is C plus I plus G is equal to C plus S plus T. So C is a constant function of income. So I plus G, investment plus the government expenditure, is equal to the savings plus the taxes. What does it mean? Sir, whatever you are going to save, just try to understand. Sir, whatever you are going to save, you will invest that money, and whatever the government will collect in the form of taxes, the government will do the government expenditure out of those taxes. It can be in the form of buying the goods and services. It can be in the form of providing the transfer payments, right, which will form the part of the disposable income. Clear? So this is the equilibrium level in a three-sector model. This is how the equilibrium level is determined in a three-sector model, right? So this is what is written here. Let's try to understand this graph. This is the income, right? And this is also the income. This is the aggregate expenditure. And here he says the injections on the leakages. What are the leakages? We discussed in the last lecture also. The leakages are in the form of savings. That is the money that is not going into the circular flow of income, that comes out of the circular flow of income in the form of savings, or it can be in the form of the taxes, right? That is not going back into the circular flow. Okay, so this is the total income line. Y is equal to C plus S plus T. C plus S plus T, that what is the total income? That is consumption plus savings plus taxes. That is equivalent to the total income that you are earning. C is only the consumption. When you do investment, this will increase. The aggregate demand is increasing. Now with the government expenditure, this aggregate demand will further increase, right? We discussed about the investment multiplier, that aggregate demand will change when the investment will increase. Here we say there is an additional factor, that is the government expenditure. With the government expenditure, the aggregate demand line will again shift. This C is a constant function of what? It is a constant function of income, right? So with the G, this line increases. As my income increases from Y to Y1, right? This aggregate demand, this function, this equilibrium also shifts to E1, right? Now this is the equilibrium point. This is the equilibrium point. Now here what happens, sir? This is the A level, that is minimum investment, and here you have the dis savings, which we have already discussed. Right? Now at Y, you are having this equilibrium where you are saving also and you are paying the taxes also. As your income increases, what will happen? Your taxes will also increase and your savings will also increase. Here, there was only investment expenditure. Here, investment plus the government expenditure. Now the government is collecting the taxes from you, but out of that the government is doing the expenditure also. So this increases, the savings also increase, the taxes also increase, leading to an increase in the equilibrium level at E1, right? So this is how the equilibrium level has been achieved, that as the income increases, your equilibrium level is increasing with the increase in the aggregate demand and at the same time the increase in savings and the taxes. The x-axis represents the income while the y-axis represents the C, I and G. Since I and G are determined outside the model, C plus I and G lines above the C line by the constant amount at all the levels. That means it is not the function of income. Determined outside the model means that they are not directly dependent upon the income. S&T curves denote the total leakages from the household sector. It is positive since the savings vary positively with the income. The level of T is decided by the policymakers, that is by the government. Equilibrium is determined at point E1 where C plus I plus G line intersects the total income line. This gives equilibrium level of income at OY1 where the aggregate demand, this one, right? This is the equilibrium level of income. At point E1, the S plus T is equal to I plus G. How, sir? I have proved this equation. At any level of income below Y1, the aggregate demand will be higher than income. That is, I plus G will be greater than S plus T. That is, he says, at any level below this income, here your aggregate demand will be more than aggregate supply. And beyond this point, your aggregate supply will be more than aggregate demand. Simple logic. Only at point E1 the aggregate demand is equal to income and there is no tendency for the output to change because there we have the equilibrium level. As the income increases, your aggregate expenditure will increase, right? And also at the same time, this savings plus taxes, these leakages will also increase. These are known as leakages from the economy because as you keep on increasing the consumption, how much money you can consume, sir, you will start saving, right? And the government, more the income, the more the taxes. When your income increases, the government will demand more of taxes from you, right? So what are the leakages? We have already discussed. What are the injections? He says in the not in the four sector model. We are discussing about, okay. The injections refer to the introduction of income into the circular flow, that how the money is introduced into the circular flow. In the leakages, we say the money is taken out of the circular flow, and in the injections, whenever required, the money is introduced into the circular flow. When households and the firms borrow money from the external sources like the financial institution, it adds to their income, right? The household and firms borrow money from external. Such additional income. Now, what will they do with this income? Obviously, they will be spending somewhere in the form of investment. It can be in the form of, the consumption expenditure, but that circle will rotate. Right? Such additional income does not result in the immediate expenditure. The injections increase the flow of income, like investment in the two-sector model, investment plus government expenditure in the three-sector model. What can be the government expenditure? It can be on buying goods and services. It can be buying goods and services. Clear? So this is how the economy works. I hope this is clear. The equilibrium level in the three-sector model is clear. That is total income. It can be spent either on the consumption goods or investment goods or the government expenditure, right? Total national income. National income can be spent on the consumer goods, the investment goods, or the government expenditure. Then what is disposable income? Sir, consumption 50 plus savings plus taxes. This is what you total earned, right? Now, S plus T is what? These are the leakages from the economy. And the government is collecting the taxes, and using those taxes only, they are providing the transfer payments, which becomes the part of the disposable income, right? So this is what is there in the three-sector model. Now let's come to one or two topics here about the three-sector model. This is what is given here. He says the government sector and the income determination. Income determination with the lump sum tax. Lump sum tax means the tax is not dependent upon your income. There is a fixed amount of tax that is being collected. We assume that the government imposes the lump sum tax, that is the taxes do not depend on the income, has a balanced budget. Has a balanced budget means whatever the government expenditure is, that much is being received in the form of tax, right? And also that there is no transfer payments. The consumption function is defined as, now try to understand. This is the consumption function which we have studied, that is C is equal to A plus B YD, that whatever the B is what? This is the MPC, and Y is what? This is your disposable income, right? That whatever the income you have in hand, that is whatever is your disposable income, out of that what you will consume and what you will save. And A is what? A is your autonomous expenditure. A is your autonomous expenditure, which we have already discussed, right? Now he says, how will the disposable income be calculated in case of the lump sum taxes? He says, Y is the total income that is earned. Y is what? Y is the total income that is earned. Now, out of that, Y, you will be paying the taxes. This is the lump sum taxes, right? So, out of total income, whatever the taxes you have paid, what is left as disposable income. So, YD is equal to Y minus T, disposable income, T is lump sum tax, right? Now we say Y is equal to C plus I plus G. Now, what is the value of C? The value of C is A plus B YD plus I plus G. But YD we say is Y minus T. So, this can be written as A plus B Y minus T plus I plus G. Right? This is what is written here. Sir, what about this? Sir, they have opened the brackets and then calculated this. No need. Just do it like this. What they have done is, if you open these brackets, you will be having Y is equal to A plus BY minus BT plus I plus G. Right? You will take this BY here. We can write it as Y minus BY is equal to A minus BT plus I plus G. Right? Take the Y as a common factor. So Y into 1 minus B is equal to A minus BT plus I plus G. So Y is equal to 1 divided by 1 minus B into A minus BT plus I plus G. Clear? So this is how it has been calculated. Simple. What is he saying is the consumption expenditure is A plus BYD. That A is the autonomous expenditure, B is the MPC, and YD is the disposable income. That out of the total disposable income, what is the amount that you are going to consume, that shows the BYD part. Now he says if the government is collecting the lump sum taxes, so what will be your disposable income? What is the total income earned? That is why out of that you will pay the lump sum taxes. So what is left is disposable income. Then he says Y is equal to C plus I plus G. This is the aggregate demand function, right? Aggregate demand function. Substituting the value of C, the C value is A plus BYD plus I plus G. Again substituting the value of YD from here, he says A plus B. Instead of YD, we are putting Y minus T plus I plus G. Clear? Based on that, this numerical problem is there, illustration number 13. Can you do it on your own? The C is given, that is 10 plus 0.75 YD. I is equal to 50, G is equal to 20, where C is consumption, I is investment, YD is disposable income, G is government expenditure, and T is tax. Find out the equilibrium level of national income. Find out the equilibrium level of national income. So this is what they want us to calculate. That means they want us to calculate the value of Y. Now what is Y? Y is equal to C plus I plus G. What is the value of C that is given to you? That is 10 plus 0.75 YD, right? Plus what is investment that is given to you? 50, plus what is the government expenditure? That is 20. Now I can write it as 10 plus 0.75. Instead of YD, what I can write is, what I can write, what is disposable income? That is total income minus the taxes, that is 20, plus investment plus government expenditure. So using that, you can calculate the value of Y, that is 260. The second thing is asking what is the size of multiplier? What is the size of multiplier, sir? What is multiplier? That is 1 divided by 1 minus MPC. What is MPC here? 0.75. So you can easily calculate the 4. Size of multiplier is 4. Investment multiplier, simple. Now, the next part is, in the second part he says the income determination with the lump sum tax and the transfer payments. Now he says out of the total income, how can you can calculate the disposable income? He says out of the total income, the government is taking the taxes, but at the same time, out of those taxes, the government is providing what? Transfer payments. That's it. Right? Now the YD becomes Y minus T plus TR. That is the transfer payments being given by the government. So rest of the things will remain same. C is equal to A plus BYD. You have to substitute the value of D here. Now what is Y? Y is equal to C plus I plus G. And C is what? A plus B YD plus I plus G. Here what you will do is A plus B, instead of YD will put Y minus T plus the transfer payments plus I plus G. That's it. Right? Clear? So this is how lump sum tax and the transfer payment. So on based illustration number 14 is there. Similar to illustration number 13, but the only thing is here you have to add transfer payment of 50 rupees. This is your homework. You have to try it on your own now. I'm just clearing the concepts. Okay. Now moving on to income determination with the tax as a function of income. Now he says there is not a lump sum tax, right? Now the tax is a function of income. It is dependent upon the income. So he says what will be the total tax? This T is your total tax is equal to, he says this T, this line shows that there is the minimum tax that will be collected irrespective of the income. This is the autonomous tax which is not dependent upon the income, some part which is being collected without being affected by the income. And TY shows this is the tax rate. This is the tax rate on Y income. This is the tax rate on Y income. Clear? Now what will happen? It is the autonomous constant tax. T is the income tax rate and T is the total tax. Right? Now what will happen? Sir, how will you calculate the disposable income now? The disposable income will be Y minus the total taxes. Right? So the total taxes can be written as, what is the total taxes? That is the constant tax, autonomous tax plus the T into what? Y. Isn't it? This is how we can write it. This is how we can write it. So this is Y minus constant T, that is the autonomous taxation minus TY. Clear? Now what is the function of C? C is equal to, one second. Now what is Y here? What is Y? Y is equal to C plus I plus G. Right? Aggregate demand. What is the C function? C function is A plus B YD plus I plus G. Now here we will substitute the value of YD, that is A plus B. And what is YD? YD here is Y minus T constant minus dependent upon income plus I plus G. So this is what is here. This is what all is given here, right? Now in this part, what he is saying is, sir, what is multiplier here? What is the multiplier here? The multiplier is 1 divided by 1 minus MPC, right? Or we write it as 1 divided by 1 minus B. That out of the total income, how much you are ready to do for the consumption expenditure. Now he says this 1 minus MPC, whatever you are going to save, this is MPS also, you will be paying taxes on that, isn't it? You will save only after paying taxes. So he says, in that case, the multiplier will be 1 divided by 1 minus B into 1 minus tax rate. Sir, you will, on the savings also, you will be paying the taxes or not? After paying taxes, you will save. You will consume after paying taxes. You will save after paying taxes. So that is the multiplier here. 1 minus B is what? 1 minus B is whatever you are saving after paying taxes. Savings after paying taxes. This is the multiplier in this case when it is dependent upon the income. So illustration number 14 you people will do based on this part. Then the next part is income determination with tax as a function of income, government expenditure is there and the transfer payments are there. And the transfer payments are also there. So government expenditure is already there. We know that. Now, what will be your disposable income? The disposable income will be out of the total national income, you will be paying the taxes, total tax, plus you will be getting the transfer payments. Now, what is total tax? What is your total tax? That is the autonomous tax plus T into Y plus TR. Or this can be written as Y minus autonomous tax plus, minus TY plus TR, right? This is what is there. Now, again, you have to follow that function. C is equal to A plus B. Instead of YD, you will substitute this value, Y minus autonomous tax minus the tax which is dependent upon the income plus the transfer payments, right? So Y becomes plus I plus G. Clear? So these are the various methods. This is illustration number 16. That is again I am giving you as homework which you have to given based on this concept. Right? So what we have discussed is we have discussed the 4 parts of the role of government and the income level, right? The government sector and income determination. 1, the lump sum tax, then lump sum tax plus transfer payments, then the tax based on the income, then the tax based on the income plus the transfer payments, right? So how the government sector plays a role in that. The taxes will be there only if there is a government sector. If there is no government sector, there will be no taxes, no role of taxes at all. Right? So this is what you people have to try now. Illustration in case you feel any problem, we can discuss it later on, right? So this was all about the 3 sector model. This is done and dusted. Equilibrium we have discussed, that how the aggregate demand is there, how the aggregate supply will be there, right? How the aggregate supply will be there. Disposable income will be consumption plus savings plus the taxes. And sir, the taxes, why it is being added? Because these taxes the government will collect and obviously they will pay out of those taxes only as the transfer payments, which will form the part of disposable income, right? So accordingly, the government the firms know that if the government is collecting the taxes, the government will be providing also something in the form of transfer payments and all those things. So that becomes the part of my disposable income. So accordingly, that forms the aggregate supply. And on the other hand, aggregate demand, the total income that you will have, out of that, what will you demand? You can either demand the consumer goods or the investment goods, or now the government expenditure will be there. This will be done by the households, right? And the government expenditure will also be there out of that total national income. Now this Y is what? This is your national income, sir, right? This is your national income. So what will you demand? You will demand consumer goods, you will demand investment goods, and at the same time, the government will also do the expenditure with which the aggregate demand will increase, because the government is also now ready to buy the goods and services, increasing the national income, increasing the aggregate demand. Clear? I hope the 3 sector model is clear to you. And we are just left with one model, that is the 4 sector model, that we will be able to quickly cover it because there is not much in that, right? Very simple model, the 4 sector model, and in the next lecture we will be completing this particular chapter. It was one of the biggest chapters, the first 2, national income accounting and the Keynesian theory, very important chapters, the one of the biggest chapters of the economics. So we will be ending with that in the next lecture, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.